going to be an exciting session, and the topic of inflation and managing investments really came through in our keynote, so I think we're going to have a great continuation of that discussion. I'd like to just hand over now to Andy Lippman, who's a partner with Morgan Lewis, and is going to be leading our discussion here. Andy, over to you.
James, thank you, and welcome everybody. This is always a key panel, because if you ask the old bank robber Willie Sutton why he robbed banks, the answer was because that's where the money is. So this panel is going to talk about the money. Well, first of all, let me give a pat on the back to Capacity Magazine. I think there's 6,800 people in this terrarium of a building. It's all the industry getting together. We're finally over the pandemic, and that's great. So we have a great panel. I don't want to waste time on an introduction. Let me ask each of the panelists, starting on my left with Ray, just to give a minute introduction, who they are, what role they play in the industry. Ray, you want to start out with C&W?
Sure. Let me start by saying we're no longer C&W. So we rebranded, announced this morning, Liberty Networks as part of the Liberty Latin American Group. My role with that is I have two hats. One is CEO of Liberty Networks, and the other is SVP within Liberty Latin America, where I'm responsible for M&A and investments.
Great. Nick?
Yeah, thanks. Nicola Truculja, Nick. I'm a managing director on the investment team with Grain Management. Grain is a sector-focused private equity fund. We manage about $8 billion, investing solely in the telecom space.
Great.
Hi, everyone. I'm Alok. I work with Macquarie Group. I'm part of the Commodities and Global Markets division of Macquarie. We're primarily a diversified financial services group based out of Sydney, but we have operations in over 33 countries. In the US, we are headquartered in New York City. We have four main divisions: banking and financial services, Macquarie Capital, Macquarie Asset Management, and CGM, that's Commodities and Global Markets. Within that, I work under specialized in asset financing. So I basically manage high-tech asset financing and provide term loans, operating leases, project loans, and basically financing for all things tech.
Great. Alexander?
Hi, I'm Alexander Pebro. I'm the CEO and founder of the new iBasis. We grew through acquisition in the past 5 years. Actually, we are celebrating our 5th anniversary next month. We are primarily invoiced for 60% of our revenues, and messaging and mobile data for the over 40%. We are now a growing company, making our turnover is $500 million. We are in 26 countries, 400 people, primarily based in Boston, the Netherlands, London, Portugal, and France. And of course, we are also in India, Singapore, Hong Kong. And we are very much pleased to be here at the ITW.
Finally,
Hi,
Kevin.
good morning. Kevin Kwan. I'm a managing director at RBC Capital Markets. I focus exclusively on the communications infrastructure side of the business. We're a full-service investment bank. I'm based in New York, and happy to be here.
All right, Kevin, hold that thought. Okay, by way of brief introduction, 2022 was a year of disruption for many of us here at ITW. Telecom investors faced a multitude of challenges, downside risks, geopolitical, rising inflation, interest rates, stock market volatility, supply challenges. We're living in what's called the VUCA world, which means volatility, uncertainty, complexity, and ambiguity, as well as inflation. But somebody told me years ago, if you're in this industry, it's not the direction of the economy that's important, but the velocity of the direction. So there's opportunities there as well. But after 40 years of largely declining inflation, inflation is building up. So how does it impact the industry? Actually, Kevin, let me start with you. We can work backwards. So how has the recent spike in inflation impacted telecom investment both in the U.S. and globally? I know RBC operates globally. And do you agree that increasing interest demand and other factors that in telecom makes telecom more insulated from inflation than other sectors? So what's your view on all that?
Terrific. Well, thank you. So inflation certainly has had an impact on the industry. I think we've been in an unprecedented time coming out of COVID where we've seen this developed world inflationary spike here in the US. I think where it has weighed the most is on labor and the supply chains, where we've seen really robust inflationary pressure. And then it's also started to influence the capital markets. And so we've seen higher costs of capital across the industry. There has been a sort of an interesting dichotomy where you've had the securitization market has continued to provide attractive financing for structured deals, but the regular way leveraged finance for non-investment grade credits has started to gap out. It continues to be been open at a more higher cost of capital. So what I think you've seen in the industry, specifically in fiber to the home, is you've seen a pullback this year in 2023 in terms of the number of homes passed that people are looking to go after. But I think the secular trend of data demand is still underpinning the industry. And so I think this time will pass and these inflationary pressures are starting to recede. But I think that's sort of what we've seen play out over the last couple of months.
So we're seeing big deals being pulled, but smaller deals going ahead. Is that your sense?
I missed the first part.
I said we're seeing big deals getting pulled, like Altice, Suddenlink, but other deals, smaller deals.
So I think Altice Suddenlink was very company specific. I mean, there were big valuation expectations, and maybe there's a longer term thesis for a potential take private there. And so I think that's a company specific issue. I think we still have continued to see deals get done, whether it's the FiberLight Morrison deal. I think what we are seeing is that the financing's a little bit more challenging. And so where you've got portable capital structures or the ability to keep the existing capital structure in place, that's an easier deal to get done as opposed to going out and needing committed financing.
Great. So Alexandra, you're operating globally, US, throughout Europe. How do you see the impact of inflation? And do you think that the telecom sector is better protected than many other sectors of the economy?
For me, that's for me, yes. For us, the impact has been primarily first on the salaries, a lot more, and so more pressure on the P&L altogether, because of course the pricing power of telecom companies is not that strong, especially in the messaging and voice business. The second impact we had, positive one, going back to your point, is that for our acquisitions, prices have gone down quite dramatically. The multiples typically for a messaging company, and CPaaS companies, which used to be, between 10 to 15 times EBITDA, are now coming down to below 10. And one of our last acquisition, Dimoco, was made with a multiple of 6 times EBITDA. So you see the difference. And the growth, by the way, is the same, because even if inflation is rising, the usage and the use cases for messaging are still extremely valid and growing.
Okay, Alec, let me ask you this. I mean, Macquarie, invests in every part of the infrastructure, right? Toll roads, airports, et cetera. So how are you looking at telecom now as part of that investment portfolio? Is telecom now a more interesting, broadband more interesting than it was, or is inflation too much of a headwind?
So there's parts of telecom that are interesting. When we analyze telecom investments, we look at how companies manage their operations and supply chain, especially during trying times as inflation. What we've seen is, like in certain markets in Europe, for example, a lot of the contracts are they're tied to the CPI rate, that's the Consumer Price Index. So in those cases, the cost of inflation is passed on to the consumer, but that's not like the norm. For example, in the U.S., Verizon and AT&T have both, they've raised their base rates. The same is happening in other markets in APAC as well. We try to focus on certain subsectors within the telco industry which are actually going. So for example, during COVID, there was an increasing demand for cloud infrastructure and for broadband. So we started looking very closely at fiber to the home, cloud computing, last mile edge computing, basically investing in data centers. So I would say there's various subsectors within the telecom industry that have actually done well during inflation. But from a more macro perspective, when you look at the larger telcos, I think they're in a better position because they have a stronger buying power. They have long contracts with power companies. So when there's fluctuation in energy prices, they have these 10, 15-year contracts. Whereas some of the smaller players, they would struggle during inflation times. But I would say overall, we've seen it to be pretty stable.
Oh, that's great. So Nick, grain management's been clearly one of the most prominent success stories in telecom. You guys have had tremendous track record. I've read you're raising more money. You guys were investing before the pandemic, during the pandemic, now after the pandemic. How is your investment philosophy impacted by all these headwinds of inflation, uncertainty, volatility, and the like? Is it an opportunity? Is it a challenge? Is it a headwind? Is it a tailwind?
Well, thanks, Andy. That's a good question. It's all of the above. We invest across the chain with telecom. So we look at all the different value systems, and quite frankly, inflation, the headwinds that come with it create both opportunities and challenges across the board. So some of the opportunities we saw with supply chain constraints led us to invest in supply chain companies and folks that would be offering services, whether it be engineering or construction, to help basically consolidate that market and provide support to the ecosystem at large. At the same time, inflation does create a headwind for our larger infrastructure players because it requires more focus, it requires more attention on where incremental capital is going, what the return looks like on that, and to your earlier point, on velocity on the other side. Fundamentally, in our space, inflation impacts CapEx above all else. While there's certainly OpEx impacts, the scale of operations really feels inflation in labor costs to put fiber in the ground or in the equipment on the other side. And that has meant that putting forward new projects, trying to expand, has taken a little bit of a hit because folks are looking for more focused projects, areas where they know they can be successful right off the bat. But with all that, I think it's important to contextualize and remember that we're still investing more today than we ever have before. So what's happening right now is the speed of acceleration, the speed of growing investment has slowed down a little bit in 2023, but it's still way ahead of where it was just a few years ago as well, and is expected to continue at that pace also.
But does this give an advantage, to the Macquaries and iBasis and, Grains and Liberties of the world during this inflation period? You're much better off being an established, deep-pocketed player?
You're much better off being an established, deep-pocketed player in any environment, in this one especially. The diversification of cash flows, of end markets, of everything else is really important in an environment like this, but also is operational know-how. If you're good at what you do, you will succeed in any environment. And being good at what you do means being focused, means being driven, knowing exactly where you're going and why, as opposed to just kind of trying to go for the tailwinds in the industry as a whole. And that's true in any environment. Certainly smaller, greenfield, nascent players will have a more challenged environment, but they always do on the other side. Finding the right successful team, backing them, and growing with them, that's what my job should be, and that's what we should all be looking to do.
Well, Ray, let me ask you this. You're at Liberty. John Malone is probably the most successful investor, even more than Warren Buffett in the last 30 or 40 years. John Malone is, famous, for looking at tax issues, recession issues, inflation issues. So, and, Liberty has a phenomenal portfolio of subsea assets, land assets, even GCI up in Alaska. So how are you guys looking at this current climate in terms of high inflation and uncertainty, complexity, ambiguity? Is it an opportunity for you? Are you differentiating yourself from the herd?
Yeah, I think John has said to me specifically, you make more money in a down market than in an up market. So I, kind of start with that. So a couple of things are, kind of obvious from it. High inflation, higher interest cost, higher cost of capital. So that, that plays into your investment case in terms of how you finance and how you fund with debt. But I think you've got to take a view on what the longer term trajectory is in the industry. And I think where you make money in a down market is really taking that longer view, because asset prices will contract. They do contract in a down market. And that's where the opportunities present themselves. And that's where you get price dislocation in that market. But it's price dislocation in the rear view mirror because you've had a longer view on where that business is going to go or where that industry is going to go. I've seen this movie a couple of times. John has seen it many more times than I have. But for sure, access to capital is going to be critical. Understanding liquidity. I think the hockey stick plan of keep putting money in and you're going to have negative free cash flow for a number of years, but it's all going to come good in year 5. I think those plans are going to struggle to get invested in. But having sight to near-term cash flow, strong liquidity, I think those businesses will continue to find investment and grow.
And you guys are continuing to invest globally, right? I mean, is there any market
Absolutely.
that you're
we separated Liberty Latin America from Liberty Global. That happened on 1st of January 2018 as a separate public company. Since then, we've done $9 billion of M&A in the region. From September last year, we separated Liberty Networks, which is our wholesale enterprise business, out from, separate reporting. It's still part of Liberty Latin America. Rebranded this morning. I think there's all going to be a lot of investment focus in this particular infrastructure. We like the nature of the infrastructure. It provides that, sight to liquidity. And ultimately, if you want to follow the money in this industry, you follow the traffic. You follow the traffic growth. You understand where that's going to be and you invest ahead of that. I think wholesale networks, data center, infrastructure, that platform of where the traffic's going to be in the future, if you can invest ahead of that curve, I think you can make some solid returns.
Well, hold that mic for a second. Let's talk about M&A. ITW has been all about M&A. I mean, for years, ITW was a petri dish, for new deals in the sector. So, the old axiom is that M&A is primarily a factor of economic optimism. Given the lower level of confidence, 2022, according to McKinsey, we saw deals are down maybe a quarter, maybe a third from 2021. Deals in 2023 look a little lighter. How do you see, the deal market now, and over the next 12 months? What kind of deals are going to get done? How has inflation, increased interest rates, impacted deal activity?
I think I actually think you're going to see it pick up. I think there's been a period where you've had interest rate rises continuously, and people haven't really been able to draw a line as to where that's going to stop. I think the sense, there's bankers on the panel who can answer it, but the sense we would have from speaking to other banks is that, it's starting to stabilize. When you have stability and you know what your cost of debt is going to be, then you know where asset prices ultimately are going to settle. I think there's been a lot of capital waiting on the wings to see what will happen on the underlying cost of debt. I think that when that settles, I think you'll also have, parties who had a view in terms of their asset and what it looked like with much cheaper cost of debt. I think those asset prices will contract a little bit and people will find a new norm. But to your point on optimism, I think the other driver of M&A is there are real cost increases. Power is increased, labor is increased in terms of the input costs into all of our businesses. Meantime, consumer purchasing power is less. So that should drive consolidation. If you get the right regulatory environment that allows for consolidation, and I think it's required within this industry. It's got a wave of capital coming at it, whether it's on mobile and 5G, whether it's on fiber on fixed, whether it's on data centers and edge compute and enabling all of that. You've got a wave of capital requirement coming at the industry players. And I think you couple that with higher input costs and lower consumer purchasing power, then the natural answer should be that you have consolidation to allow for those investments to take place. The job of the regulators, I think, is to figure out how do I allow consolidation to ensure my market gets the investments required, but also protecting the consumer. And I think that's the balance that they need to walk. And you see the US and the mobile industry, it's always a great example. That's contracted to 3, going to 4 players. We operate in many markets where there's still 4 players with much smaller populations. You're seeing consolidation take place though, but I think more consolidation will be a result of this environment. Once you get the right equilibrium of cost of debt is clear, asset prices are at transactionable levels, and regulators understand that if they want technology investment, which is key to their growing their economies, they're going to have to allow for more consolidation than maybe they have in the past in a different environment.
No, thank you. I agree. I think the cost of debt is absolutely essential. But we're also seeing a lot of headwinds from regulators. I mean, look at Microsoft, Activision, look at Tegna, Standard General. Smaller deals are getting done, but in the EU, the UK, particularly the US, there's a very strong populist resistance to acquisitions. I don't think that's impacted grain at all. And, you've operated, very effectively. But, how are you seeing the M&A market? Again, you guys have been investing, for a decade or more. What's new today? How is 2023 different than the last few years?
Yeah, thanks, Andy. So, I think what we've seen in 2023 is that there has been a slight pullback in activity in the M&A market. Less deals coming to market, less deals getting done. Doesn't mean we're any less busy. We're always looking for where those opportunities are, and we continue to make investments on our side. But just generally speaking, folks have been taking time to digest the new environment they're in. They're trying to get used to new rates. They're trying to understand where debt availability will come from. They're trying to understand what new sources of capital they have, because there's emerging private credit sources that are coming as well. I think as I look forward at the calendar, there is a pent-up demand for deals that'll be coming through. The big thing that needs to happen is that everybody needs to get used to the new normal, right? There is a new rate now in place. There's new sources of capital on the other side of it. And as people begin to digest that world and develop business cases around it, you'll see more and more flow come on the other side. Furthermore, I think what you're seeing, especially today in the market, is more of those middle market deals, kind of less than $1 billion in enterprise value getting done because they're smoother to get through, they're easier to finance on the other side, there's a smaller syndicate of banks necessary for them. Again, as we hopefully have a rate pause or whatever else on the other side, we'll see those larger deals start to kick back on again, and hopefully by the second half of this year, we'll have a much different tone around where M&A activity is coming from.
Great. So, Alec, let me ask you, Macquarie is a global investor. How are you seeing the M&A market? Are you seeing it more difficult in developed countries like the UK, the US? Are you seeing it easier, or where on the chessboard, does Macquarie think that M&A would be advantageous for you?
So for Macquarie, our primary investment arm is Macquarie Infrastructure and Real Assets. That's like our biggest infrastructure fund. We currently have under $576 billion in assets under management. Through that fund, we have acquired a bunch of telecom companies. One of our flagship telcos is TDC in Denmark. In the US, it's Cincinnati Bell, which got rebranded to Alta Fiber, Hawaiian Telecom. So we primarily look at how telecom operators are modernizing their networks. Are they currently following the trends? Are they going against the trend? And we make our decisions in terms of investments and mergers and acquisitions based on the technological advancements that we see that the operators are making. So, for example, in the U.S., there's a big push for fiber to the home, with a lot of grants that are being provided by the government, like RDOF,
Exactly.
CAF2. So Macquarie looks very closely at partnering with the government and providing private equity money to these much needed telco operators.
Now, you've done that, I think, in Kentucky, right, with the state network?
Right. Kentucky Wired was an initiative which was basically rolling out fiber in 512 counties in Kentucky. And that was just one such program that Macquarie Capital actually did. But apart from that, we're also looking at individual cases where there's a whole bunch of fragmented broadband and ISP providers that we see a lot of consolidation that will happen over the next couple of years.
Great. Alexandra, Tofane, recently bought iBasis. You've been involved in a lot of M&A. Again, M&A is largely a factor of optimism, right? If you don't think the economy is improving, if you don't think, it's going to be opportunistic, why pay more than the market value? So where do you see M&A now, and where do you see M&A going, both in Europe and the US?
Yes, we see more opportunities, but as Liberty and Macquarie pointed out, for us it's going to be a lot more focused than what you are. We see the opportunities coming with the part large groups want to carve out so that they have a fittest profile for the markets. Typically, especially in our industry, being able to, we see more opportunities in carving out the voice and the messaging business, because that's very dilutive for large groups such as the Liberty Media typically. And that's one thing. The second thing is that we have, with our new investors, the possibility to mobilize a lot more money in Europe or in the US as soon as we get the targets well identified. And the last point, to stay in the inflationary environment, is that advisors now to do the deals are a little more expensive, so we can be a little more demanding with them. And it's a pleasure to work with Morgan Lewis.
Well, thank you. Thank you. Kevin, you're at RBC. Somebody once said the Canadians are the most optimistic people in the world. I'm sure as a banker, you want to be optimistic, but how do you see deal flow now? How do you see deal flow over the next 12 months?
So I think, the theme being inflation here, we have seen some slowdown over the last, call it 6 months, with the pressure from inflation kind of weighing both on operations and on the cost of debt side. I think with a little bit of creativity, though, there's still a lot of opportunity. And I had mentioned earlier, if you look at sort of what's been happening in enterprise fiber and fiber to the home, with being able to finance through the ABS securitization market, that's been a huge new development over the last 2 years that's created, north of 9 times leverage and at a very attractive rate for raising capital. So I think that's an interesting pocket of capital to go and look at. That takes a longer term view around infrastructure. And you've seen, Metronet raise 1.9 billion. You've seen Summit IG come. You've seen Bluestream come, Hotwire. So this is a developed market. And I think with a little bit of creativity, you can structure a deal. Maybe it takes a little bit more equity up front, but I think the underpinnings of the communications infrastructure demand are going to continue to drive consolidation. And it's very difficult to find good management teams with good platforms. And so I think there's still a ton of capital out there trying to find those right opportunities. So I think as you look forward, especially as we get to the Fed inflection point here in the US, that there is going to continue to be consolidation as you look forward once we find that stability. And it feels like we're getting closer if we can kind of get a soft landing from a economy standpoint.
What about fiber to the home? That area has been really overheated. Do you think there's going to be more M&A there, more consolidation? And again, I invite any of the other panelists to speak up.
So I think the consolidation on the fiber to the home side is probably a couple of years out. A lot of that funding is already in place. Take like a Brightspeed, where they overfunded it at the close to be able to do the build out. So I think between Frontier, Brightspeed, and the build out lift that needs to happen over the next couple of years, I think those management teams will get through that build out, and some of the subsidy funding that's coming down from BEAD and other sources, I think that will fund the build out, and then there'll be a phase where you need to consolidate and do a cost consolidation. So I think that will come. It's probably a couple of years out.
Yeah, I just wanted to add, we've noticed with BEAD, I know you mentioned BEAD and CAF2 and RDOF, these programs, they have milestones in place where you have to basically deploy a specific percentage of fiber over the course of a number of years. And once you achieve those milestones, the funding is being released. So I think the consolidation is coming, but it might take maybe 4 to 5 years for it to really materialize. And that's mainly going hand in hand with the funding programs that we're seeing so far.
Great. Nick,
Yeah, I was just going to add, on the fiber to the home side, the runway of organic growth in that space, especially in the US, is immense. There's any number of millions of homes still left to be kind of fiberized and connectorized. On the other side of that, from an operator's perspective, consolidation for those kinds of assets is actually very, very difficult. And to do that while you're growing at breakneck speed, it's not the easiest thing in the world, because part of the thesis that you're going to make in any kind of consolidation play is that growth continues. So at least from our perspective, the way we think about it is investing into that organic growth opportunity is the best possible alternative right now. And then at some point, as the teams mature, as the markets mature, as a lot of those efficiencies get worked out in the system, that's where a consolidation wave will come on the other side of it, because that next wave of investment will be even more difficult when there isn't that greenfield opportunity on the back end of it. And consolidation will have a lot more value at that point.
So let's talk about winners and losers. In preparation for this panel, I went back to my old notes. I was fortunate to be here at the first ITW. We had great sponsors: WorldCom, Enron, Global Crossing, Flag. I don't see them out there. Okay. So our sector has had winners and losers like every sector. But in every economic cycle, there are winners and losers. So let me start with you, Alok. Who, in your opinion, are the near-term winners and losers over the last few years of creeping inflation? And presumably, will inflation have more of a disproportionate negative impact on new entrants? So, how do you think the winners and losers fall out over the next year or two?
Is that for me?
Yep.
In terms of, we see like the big telco companies more or less being stable in terms of inflation or other geopolitical risks. So we don't see, from a long-term perspective, much of a change on that, on that side. But more of the new entrants and the smaller players we see have been struggling, especially during COVID. We saw a lot of the smaller players struggle with supply chain issues because a lot of these companies don't have the right partnership with their vendors, the right subcontractors, the right field services providers. So these long-term contracts actually matter, and the big players actually have that down to a science. So we see actually that as an opportunity to help the small players by stepping into the ground zone with them and trying to invest and trying to help them grow so that they get to a level where they actually, within 5 to 7 years, either get acquired by a bigger company or actually go on their own path. So that's where we see it going.
One comment that I'd just make on that is, on the fiber to the home side, I think it's move as fast as you can to plant the flag, because the person that gets there first gets the penetration. And so I think that's where businesses that are well capitalized and were previously capitalized have a little bit of an advantage for that race to penetration, to be the first one in to take market share. And so when you think about the more growthy fiber to the home opportunities, I think there's a little bit of a race to be first.
But doesn't fiber to the home winners and losers turn on a balance sheet? I mean, we saw AT&T, actually, I was involved, do a deal with BlackRock out of market. We're seeing some of the incumbents, Frontier, Lumen, cut back on their fiber to the home. Isn't this fiber to the home race going to go to the best balance sheet?
Let me take it. I think there's a matching of balance sheet to assets. So what I mean by that is I think you're going to see more network delayering. If I look at that transaction, and obviously wasn't as close to it as yourself, but if I look at similar transactions, you're matching capital, which is really infrastructure that's going to be built for the next 20, 30 years, with the right pockets of capital, with 20, 30-year capital. And there's no question in terms of that return. So I think, there's no question in the US and across Latin America as well. I mean, Latin America, I think we've got of high-speed data connections, 55% of them are either fiber or 1 gigabit ready connections across the market generally. So, but even at that, there's still more demand than there is capital available. So you're going to find parties and pockets of large institutional capital that want to match 30-year money with 30-year investments. That's not necessarily the incumbents.
I mean, is that mostly private money? Is that like private equity primarily?
It's
infrastructure funds?
Infrastructure funds. Infrastructure funds, for sure. And I think the model of actually delayering, where you get, it's another path to consolidation, where you're getting multiple retailers on one single network. That I think is it's not a theme that you're seeing play out in the US, given the number of potential retail parties, but it's a theme that you're seeing play out elsewhere.
Go ahead, Nick.
So, I was just going to add, the best balance sheet in the world can't make up for bad execution on the other side, right? So as much as it is about a race to plant the flag and be first in a market and have the resources to be able to support yourself as you build the cash flows and build the customer base and continue to expand, it does at the end of the day come down to how solid are your operations, how good is your sales track record, how much are you able to drum up business on the other side to get those customers going. To your other point around the pullback that we've seen, as I interpret it, they announced, a lot of these companies, including many that we're invested in, announced some of the largest fiber to the home expansions we've ever seen. So to the extent that there is a pullback, it's not in the grand scheme of things that big relative to how big of an investment that they're still making on a go-forward basis. And surveying the environment that they're in, the labor shortages, the supply chain shortages, and the rest, they are refocusing their efforts on making sure that what they do build, they execute on. And that's much more important on the grand, in the end, to generate the returns that they're looking for, whether they're targeting a 30-year or a 10-year or whatever return cycle on the other side.
Now, let me jump back to you. Something Ray said, something Nick said, about infrastructure funds. I mean, I'm looking out the audience. I know many of you, I think, many of you would agree with me. Up until 3 years ago, there probably was like 1 or 2 infrastructure funds walking around this conference. Now there are literally in the dozens, maybe more. So what is it over the last few years about the telecom sector, the broadband sector, that the infrastructure funds are turning away from sewers and toll roads and, putting more emphasis on broadband?
Well, it's critical infrastructure, basically. It's infrastructure that's required at all times. That's what connectivity is. And that's one of the big hallmarks of our infrastructure funds is we are going hard and fast after highly high-tech, technology companies in the data center field, in the fiber to the home. I know Nick just mentioned, execution is very important. So we also look very, very closely at how companies are actually executing on their plan. So in the case of fiber and with WISPs in general, it's really important that they have a good handle on the take rate of their fiber. They have good relationships with their vendors, so that in economic downturns and if there's supply chain issues, they always have their operations under control. And that's what we really focus on is how well companies are executing, how well they have deployed their initial networks. And we will continue investing in these companies as and when possible. Yeah.
Hey, Alexandra, iBasis is clearly a winner. Well, can you talk about your thoughts on winners and losers, particularly going forward?
Thanks. For us, I'd say to stay on the winning side, we feel that skill and making sure that we have access to a good, deep resource in skills is very important, and that's why we have now opened our own branch in India now over a year ago, and that we are actually growing quite rapidly there. Because it's a huge market. It's really the first country in the world now, and with a very quite young population, still growing, with a middle class growing quite rapidly as well. And there you can see the future, meaning that it's not only that they have, of course, supplying skilled resources throughout the world, but within the country we have an own growth. So I would say that's for the first thing to be sure to stay a winner in the coming years. The second thing is to go to the OTTs and make sure that now we provide them services that are growing services, such as all the digitization, digital services they want to support the global access they need worldwide. And then the last thing we do in a very industrial way, look for new targets. And I'm remembering now that RBC actually was our advisor to make this Altis acquisition in Europe 5 years ago, and thank you for that.
Great. Well, let's look at the title of the panel, Prioritizing Investments in an Inflationary Environment. And Nick, let me talk to you for a second. One of the key drivers of this sector, for all of us, fiber, data center, towers, has been the hyperscalers. Okay, last year hasn't been particularly kind to the hyperscalers. They've been under more competition, regulatory microscopes. They've cut back. They've laid off people. They've tightened their belt. Meta, for example, has canceled or delayed certain leases. How do you expect that trend to continue? Do you think the hyperscalers are going to continue to play the kind of role they've played over the last few years, or do you think it's going to change?
Yeah, well, look, from our perspective, we haven't invested in the large hyperscaler data centers and the like. The yields and returns there are relatively low for what we look for, and that's a testament to the bargaining power that these companies hold, and also the astuteness of their teams to make sure that they're driving the most competitive bids for any one of their services. And we see that through the fiber companies that service them or services companies that service them. They are a great customer, and they're also a very tough customer on the other side. They make sure they get the most out of it. But across the board, what we see from larger companies this year has been a pullback on CapEx generally in an effort to preserve cash flows. As I interpret it, it's more of a timing item rather than a change in the underlying dynamics of our market. They're looking at an environment where they know or they expect from what they're hearing from their bankers that rates will stabilize, potentially even go down on the back end. Times will change effectively. The cost of investing into these data centers or into those networks, the capital costs will either stabilize or come down even in the relatively near future, 6 to 12 months. So pull back now, retrench, reorganize to the areas that need to be kind of focused on, and then hopefully we'll see a pickup back again on the other side.
Ray, let me ask you, I mean, Liberty has a lot of assets. I'm assuming the Atlanta Braves aren't impacted by the hyperscalers, but I assume that a number of your subsea assets and other facilities are. I mean, how do you see this trend continuing? Is it a fluctuation? Is it a one-time issue, or is it a trend?
I don't think it's a trend. I think the long-term trend is what I said earlier. It's you follow the traffic to follow the money in this industry, and they're the largest generators of traffic, will continue to be, and that will continue to grow. In terms of their specific investments in whether it be partnering with likes of ourselves in Liberty Networks, or whether it be investing in hyperscale data centers, like every other business, they're going to look at the capital environment from one year to the next, but the longer term, there's no question they will continue to drive this industry. That's my absolute view.
Great. Let me ask you, Alok, how do you see the role of the hyperscalers? I mean, do you think they'll continue to own facilities, like subsea or, data centers, or will they, revert to more lessees? Will they be more or less willing to do JVs? How do you see their role in the sector?
I mean, I would say we're more interested in the actual assets within the data centers and the actual technology that goes into the data center. So the specific servers and the way these data centers are able to monetize. We're observing a lot of co-location. So multiple companies using a singular source of data center. We're also observing where usage of data is actually more or less like a commodity nowadays. So we've seen hyperscalers actually achieve this very easily by charging their customers based on the data rate that they're using. So basically, we're seeing a lot of growth in this area, and I think from a technology standpoint, we will see more advanced servers that are being installed in these data centers, especially with newer semiconductor technologies being introduced. Currently, the leaders are Cisco and Juniper in this space, but there's a whole host of OEMs that are also competing for the data center market. So we see the hyperscalers. Actually, it's sort of systemic that we saw some layoffs. It was not. I don't think it was due to inflation or due to external pressures. A lot of these hyperscalers have probably poor human resources management, and that was a result of most of the layoffs that we saw with Google, AWS, and Meta. But I see it as a long-term, very stable and growing space.
Great comment. Alexander, what's your view from Paris? Do you see the same perspective?
Sorry, yes, about the same perspective, even from Paris. The one point I think is going to be very different in the coming years is the Ukrainian war on its consequences and the rising tension with China. I think that we are really in a completely different world than what we used to be. I don't know for you, but really, especially Canada, used to have very good relationship and ties with China, but not anymore, no, right? I mean, you are in the middle now.
The only thing I would add is that I think there's a huge secular trend of moving to the cloud. And if we were to move into a recessionary environment, that may even accelerate. And so I think you're going to continue to see demand driven to the cloud. You're seeing all sorts of new workloads, whether it's AI. And so I think that trend of hyperscalers and hyperscaler growth is going to continue in this space.
Great. Well, I know we're a minute or so over our allotted time, but Kevin, let me start with you. Go down the line. You know, this is a forecasting panel, a prediction panel. I know all of you brought your crystal ball here to National Harbor. You know, let's leave us with one thought, you know, where you see the economy going for the sector over the next few years.
So
Are you like those faces in the restrooms? Are you happy? Are you sad? Are you neutral?
So I'm ever the optimist. So I think when we're sitting here 1 year from now, we're going to be in a lower inflation environment. I also think as we get to that Fed inflection point, you will start to see rates come down, which will be another catalyst for support for this industry in particular. So I think as you look out, given the underpinnings of growth, lower rates, and a more benign inflationary environment, I actually think it's going to be good years are ahead of us.
All right, good to hear in our sector. Alexander.
Yeah, good years ahead of us. I think we'll see a lot more consolidation than we used to. I think it's going to start again. And I think on the inflation, because so much money has been printed during COVID years, it will stay a little longer than we all expect, but manage at a lower interest rate level, indeed.
At Macquarie, we always say we're not the cheapest money, but we're the smartest money. Yeah, I mean, with 5G, IoT, augmented reality, virtual reality, hyperscaling, cloud edge computing, we see a lot of opportunities for us to invest and help these companies grow. So the outlook is very positive.
Yeah, I think from my standpoint, we're very lucky to be in a sector where the tailwinds are so strong. As customers and as consumers continue to use more and more of our services, they demand ever more of them on the other side. So many of our inflationary pressures and challenges are driven primarily by excessive demand. Folks want more and more and more connectivity across their lives in every environment that they're in, and that's a great place to be. Certainly, once interest rates stabilize, once sources of capital are more common, we can invest more and therefore grow more. But on the other side, you're seeing that proliferation from infrastructure funds, from private equity funds, and from others coming into the sector. Why? Because that demand is being driven from the bottom up, and that creates a really, really stable environment to invest in.
Sure. On my side, I think, you know, I was talking to somebody even earlier today, and they said, look, we're not seeing the same growth in traffic that we saw in the past. It's only at 30%. I mean, what a great industry. I mean, you're in a recessionary environment or going into a recession, it's saying it's only 30% demand growth. That is the backbone of this industry. Our role is to allocate capital to assets that you can make a return from that traffic explosion. I mean, we split off LATAM for a specific reason. We see it as a region where there's probably more traffic growth there than any other region in the world as it catches up. It's also leapfrogging a number of other technologies. It's you know, it didn't go through the copper phase to VDSL. It's straight to fiber. So we're very excited about Latin America.
Well, you know, a high tide raises all ships. I actually started out as a railroad lawyer for 2 years before I got into telecom, and the last advance in railroad was the steel wheel and the steel rail. So I too feel really fortunate being in this industry. I think this is a great wave of optimism going into ITW, and I think this optimism is going to carry into, believe it or not, an even larger ITW for 2024. So huge round of applause, please, for our panel.
Thank you.